Hi there everyone, it is Monday the 20th of November, and that means it's time to take a look at what moved the markets last week. The strongest influence by a long shot last week would have been macroeconomic data. Markets moved quite sharply through the week, and one of the key influences was the CPI number out of the US. Most measures of CPI came in slightly under what was expected by analysts, and the market would have taken a sigh of relief given that there was a little bump, like you can see on screen, with CPI climbing for the 3 months following June. It's quite interesting to dig into this data in a bit more detail. It's all available on the US government website, as you would expect, and you can see that some types of inflation, for example, food inflation, was sitting at around 3.3%, whilst others fell quite sharply. So here on screen we have energy services dropping by 21.4%. Another one of the big ticket items pulling that CPI number down, if you look a bit further down, was the used car and trucks line item. I'm not sure how many of you have been following this data, but at one point, second-hand cars were being sold for more than the new price that they'd been bought for many years before that. In addition to this, we also saw the PPI number, producer price inflation, come in significantly lower than expected. So you can see that the expectation was for a rise of 0.1%, whereas instead it fell by 0.5%. Now the CPI number is a lagging indicator. It's a backwards looking number. It measures what happened with the consumer, whereas the PPI number tends to be an indicator of where CPI is going to be. That's the type of inflation that happens in prices that are upstream of the consumer. So for example, you want to buy a new iPhone. Well, producers need to do various things in order to build and procure the parts and ship the iPhones themselves. So this is the leading indicator that tells us the prices that those manufacturers and service providers are paying, and that later on will be passed down to the consumer and that we will receive in the CPI number. We also got the retail sales number out of the US, and it was expected to fall by 0.3%, but it only fell by 0.1%. So the consumer is still out there spending money in the US at least. And we also got the initial jobless claims number, which gives us an indication of where unemployment is going in the US. You can see here that it came in at 231,000, whereas 220,000 was expected, and it seems to be rising quite sharply, which could create a problem down the line. We have to keep an eye on it. The market absolutely celebrated this collection of data. So inflation falling by more than expected, leading inflation falling by more than expected, retail sales stronger than expected, although falling, and the labor market looking as though it's beginning to soften. Investors celebrated this by buying into bonds. So you can see, for example, the yield on the 10-year bond has now fallen 11-ish% over the past 2 to 3 weeks. And this tells us that there's an expectation that the Fed is probably not going to raise interest rates from this point. At the same time, stocks rallied quite strongly. You can see I've got the S&P 500 on screen, and the orange line is the IWM, the Russell 2000 ETF. So those 2,000 smaller companies in the US economy that are publicly listed. And the numbers may be a bit small, but the S&P 500 rallied about 2.5% through the last week or so, whereas the IWM, those smaller companies, rallied by more than double that, nearly 5.8%. The reason that I also wanted to pull this chart up on screen is to give you an idea of the difference in terms of price action through this year. This chart runs back to the beginning of January this year, and you can see that the S&P 500 is now up 18.5%, whereas the Russell 2000, those 2,000 smaller companies, have only risen by 1.7% this year. This divergence is both very interesting as well as very scary at the same time, and I'll tell you why. So the thing that concerns me about this divergence, and it's not immediately clear from this diagram, is that the bulk of the return on the S&P 500 has come from a very small number of companies. It's much clearer on this chart. Apologies for this image, I couldn't find a higher resolution version, but the left-hand chart is telling us that the 7 largest companies as a share of the S&P 500 total market cap are now 29% of that index. I couldn't find a chart for the Magnificent Sevens total share of the NASDAQ 100, but it is much larger even than this number. The right-hand side chart is even more interesting. So the Magnificent Seven, that is Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, have provided an index return of 71%. The S&P 500 overall, like I said earlier, is about 18-19% for the year so far. But the combination of the 493 remaining companies in the S&P 500 have only provided a return of 6%. In my opinion, it looks as though the Magnificent Seven have experienced what is usually called a melt-up. A melt-up describes the behavior of a collection of stocks, usually an index. And in summary, it means that the collective prices of those stocks have gone absolutely bananas. This is usually preceded by some positive price action within those stocks, then some fear of missing out, so people buying into those stocks. That going on for so long that people no longer feel like they can lose by investing in that collection of stocks. And more people jumping in. The problem is that this exuberance eventually ends for some reason, and the prices of those stocks start to fall just as sharply as they rose. This is by no means a reflection of the underlying businesses. These are all fantastic companies, but it does feel as though a combination of greed and also a flight to relative safety of these stocks has driven the prices way beyond where they should be. The reason that this is concerning is that these companies are so large that when they fall, they will obviously pull the indices down, but also that will drive sentiment towards just about all the other stocks in the stock market, pulling them down too. On the flip side, the reason to be excited is that there is such an enormous mismatch in prices between smaller businesses and the very largest of the large businesses right now, that there are some incredible opportunities waiting within this basket of stocks. Now, a worst case scenario, big collapse in the prices of the Magnificent Seven is by no means guaranteed. They could instead trade sideways, they could instead start dribbling downwards. But what I think is incredibly likely is that as it becomes more certain that interest rates are going to fall, and we got a taste of this last week based on all the data that we received, we should see the share prices of these smaller businesses start to climb. I suspect that if there is no large piece of news that causes the share price of the Magnificent Seven to collapse, we will just see a pivot of money that has entered these stocks through the past year start to move into the better opportunities of these smaller businesses. So we didn't see a lot of companies reporting earnings last week, so there's nothing really to update there. And this week is also going to be a quiet one. The US has their Thanksgiving holiday on Thursday, and then they will close early on Friday, and most of the US will take both Thursday and Friday off. I think that the piece of data that most investors are going to tune into will be the meeting minutes that we receive tomorrow at 7 p.m. And that's because they will be seeking some sort of confirmation that, given the data that we've been receiving recently, that the Fed is likely to keep interest rates at current levels instead of raise them through the remainder of this year. All right, that's it for this week. I hope you have a good one. I'll speak to you soon. Goodbye.